Braving the cold to be with us today at our 2022 Commercial Real Estate and Economic Forecast event. We did this last year virtually in anticipation, of course, that we would be back to the old way of doing things by now, and so we are trying our best. Of course, just like real estate, the COVID-19 pandemic and our response as a society is ever evolving. So we are attempting this. We are also recording this as well, as I mentioned, and we'll be sharing the slides with you. We're grateful to Casey Conway, who is with us once again for this much anticipated update. Not only will we be looking back, but more importantly, we'll be looking ahead. What does the past tell us about the future? And what does our current state show us about how we respond to the inevitable changes before us? First, I want to thank our annual sponsors, many of whom are in the room today. Also, many displayed on our panels. We have to update those. Big shout out to our partner sponsor for like the 5th or 6th year in a row, Ergens. And thank you to all of our annual sponsors, of course, for being here. Now, let's introduce our speaker. He's going to speak for about an hour. We'll have time for question and answer as well. And he's very punctual because I believe he has a flight to catch out. He flew in this morning and then sent me an email and said, "How do you do this in the cold?" And he's flying out tonight. Hawaii, right? Just kidding. Okay, Casey is an economist and futurist and holds designations of CCIM, CRE, and MIA. He is in the mind trust behind the Red Shoe Economics LLC, an independent economic forecasting and consulting firm. A proud graduate of Emory University with more than 30 years experience as a lender, credit officer, appraiser, instructor, and economist. KC is recognized for accurately forecasting real estate trends and ever-changing influences on markets all across the United States. With credentials from CCIM Institute, Counselors of Real Estate, and the Appraisal Institute, KC currently serves as chief economist of the CCIM Institute and as an independent director for Manmoth REIT MNR. KC has made more than 850 presentations to industry, regulatory, and academic organizations in the last decade and has been published in many national and regional newspapers and journals with frequent contributions as radio and television programming. Please welcome Casey Conway.
So it's not advancing. While he's getting that going, so just for you guys, I was down in Miami last week, and I walked in the hotel room and the hotel lobby, and here's this men's clothing store, and they had this jacket hanging in the window. And I said, "I'm the Red Shoe Economist. If they have that jacket in my size, it's a sign from God that I need to buy this jacket." The first one hanging right there was my size, so I had to buy it. And I thought, it would be a good one to wear up here today because it is a little cold. When I got off the plane, I said, holy bad word. It's cold up here. How do you do it? So this is where you need to be. And so this is to distract you from that it's cold outside. All is going to be good. So anyway, and I even brought my very, very special, so some of you are in the back, I'll see if I can do this without falling over. I'm almost 60 here. So these are the very formal, my very first best shoes that I had to wear over at the University of Alabama. They had to be crimson red, not just regular red. So I had to do that for 6 months during my probation because my first email to the dean, I didn't know they played football in Alabama. Did y'all hear that rumor? Georgia thinks it's a rumor too, after the national championship. So the dean made me wear these red shoes for 6 months during my probationary period until I could learn all the SEC statistics about Alabama. I've worked really hard the last year and a half to forget all of those statistics. So I can't tell you any of them at all. We could just do it manual if you, I'll advance it manually. So you think it's working?
It was working just now.
All right, there we go. It's always good when that happens, but I've had everything go wrong. So I'm really pleased to be here with you. When my son asked where I was going, I said Milwaukee, and he says, "Where's Milwaukee?" So he's a special needs 11-year-old son. And I said, well, he has some relatives that live in Chicago. I said, it's kind of near Chicago, but it's the safe part of the Midwest. He said, "Oh, I'm so glad, Dad." So he thinks I'm in the safe part of the Midwest. So I don't know if any of y'all had Chinese food, gone out to a Chinese restaurant so far this year, at the end of the year? Well, if you do, look at the paper mat or whatever, and they have the zodiac calendar around there, and it rotates every 12 years. This is the year of the tiger, and it's the water tiger, and what it means is a year of extremes. And if you go back 12-year segments, let's go back to like 1974, Watergate, the beginning of Jimmy Carter, all the great inflation that I think we're headed for right now. Then go forward to 1986. Those of you that have a little bit of gray hair, you might remember the change in the tax law, the start of the savings and loan crisis. Then advance forward to 98, Y2K, and all our panic over that. And then there was this thing in 2010 that happened. It was pretty bad. And now we're at 2022. I think the tiger is right. I don't know about the rest of the damn other 11, but this one scares the heck out of me. So I'm a little worried about it. So when you think about extremes that we have this year, obviously we have the inflation story, we'll talk about that, FOMC meetings, COVID variants, supply chain disruption, midterm congressional elections. Everybody just get out of a city. Do not be anywhere near a city next November, or this November. Don't anywhere. I think if you thought there were riots and whatnot that happened last year and all this, you haven't seen anything yet, because neither extreme can accept the results. Just think about that, how divided we are and how whatnot. And then commercial real estate values. I want y'all to really think about this. So this is a scenario that's set up for this year. And by the way, I'll tell you, commercial real estate does very well during inflation, because the next thing that you want to build costs a whole lot more to build. So it does pretty well. But here's the scenario we have right now. Expenses are rising quicker than revenues and rents, in which you can get through on rent increases. And if the Fed moves with 4, 5, 65 rate increases, whatever it's going to be, they don't know. Hell, they're guessing. What happens to the cap rate? Cap rate compression's over with. So if you have a rising cap rate, expenses growing better than rents, what's got to happen? Our old formula, income divided by the price or whatever equals the rate. What happens to the value? It's got to correct. And so I think we've had the party. It's going to be good, but this isn't going to be New Year's Eve, what we're going to go through this year. So I'm very concerned about that. All my contact information, they're going to have all the slides available to you, but if not, just email me and I'll shoot them to you from the airport. This is my disclaimer. So I learned at the Fed, when I was the only one that would go out there and speak the truth, because the rest of them were terrified. They never climbed. At the Fed, they never climbed a tree. There's not one Fed official that's ever climbed a tree, because they don't want to get high enough and out on a limb to actually know what the hell's going on. So I'd go all the way up and all the way out on the limbs and talk. So these are all my opinions and my thoughts, and everybody's been protected. So Tracy, the realtors of Wisconsin are protected. All right. This picture shows what concerns me for this year in the outlook. We got FOMC, the Fed, inflation, logistics, and black swans. Those things that we're not just looking for, like crazy dictators in North Korea that are shooting missiles again, like China that said, maybe we won't stop at Taiwan. Let's go ahead and take Japan too this year. Or Russia, which, the U.S., they're not strong anymore. We can go ahead and take Ukraine. We are going to be challenged this year. And think back just this last summer, when we had the Russian cyber attack on the Colonial Pipeline and what it did with gas supplies and natural gas and fuel for the whole East Coast. In Atlanta, we couldn't go 2 days without gasoline. We had shootings like we were in Chicago to get an extra 5 gallons of gasoline. It's absolutely incredible. We do not have the same generation and tolerance of people to deal with inconvenience. This weekend in Atlanta, we had a little ice storm, and the supply chain in the grocery stores are already challenged. So when I finally was able to get my son from school and go to the grocery store and walk around, I went 4 straight aisles where there was nothing. No bread, no milk, no meat, no snacks, no potato chips. I was like, what am I going to do? My kid doesn't have carbohydrate snacks, I don't know. So anyway, I want you to look here on the left at the Federal Reserve. So I put the calendar of meetings, and this is something people aren't paying attention to. So the Fed has a meeting next week. If they don't raise interest rates, we're screwed, because they won't have another chance until March. There's no February meeting. And by March, the CPI is going to be over 10%. There's almost no way of putting the genie back in the bottle right now. So pay attention to these meetings and make your investments about a week before, investment changes a week before, because they're going to screw with the market all year long. And this thing about the Fed just moves rates 3 or 4 times. Remember, this is the same Fed that 9 months ago said, we're not going to move rates or do anything till 2023 or 2024. And then they made up transitory, then transitory longer, and now forget that. This is just 6 or 9 months. This is the most reckless, incompetent, plugged-in Fed I've seen in my 35 years, and I think since World War II. So I put on here the different districts, and I have 2 points here. So you guys are in the 9th district. You're just above Chicago in the 7th district. Pay attention to that. Chicago does a pretty good job. Your interior Fed districts, they actually know what's going on. They're in touch with, growing food, producing food, manufacturing, supply chain. Forget anything that comes out of San Francisco, Atlanta, or New York. They have not a clue what's going on. So Atlanta, down there in the 6th district here. And I was at the Atlanta Fed for 5 years, and then the New York Fed during the housing crisis. So you may not realize this. We've had a lot of talk about LA and Long Beach, having a hard time getting the ships unloaded. There's 80 of them out there. Well, here's a news flash. The Atlanta Fed, in their district, from New Orleans all the way around through the Gulf, Florida, up here into the Georgia ports, they have 20 ports and 5 Class 1 railroads that move more containers and goods than 2 LA and Long Beaches, and you haven't heard one story. And guess what? We're moving things just fine. We move in and out of the interior of the country. We're up 30, 40%. We're setting records. You'll hear me talk in a minute, we're gonna remake our supply chain from West Coast to East to North-South. It's gonna take about 2 to 3 years, and that's when inflation will get tamed. Because we'll have all this figured out, there'll be no more disruption. We don't care where a hurricane hits, because we've got 20 ports along here, and it's not gonna hit all 20 of them, and we'll be able to keep working. The next thing over here, if you hear them talk about the CPI, the Consumer Price Index, when I was at the Fed, we actually went to grocery stores and we bought a basket of goods. And we don't do that anymore. They all do it electronically. Well, what you don't realize is the CPI index, it's like a guy at a casino, a crooked casino in Las Vegas, playing games with the cards, and you don't have a chance at winning. Whatever the Fed wants that CPI number to come out to be, it starts screwing with it. So I'll give you an example. After 2009 and 10, home prices were dropping pretty precipitously. You know what the government did, the Bureau of Labor Statistics did, to fix and not show what the Fed was most panicked about, deflation? They changed the weighting of shelter from 45% to 25%. No deflation. They just changed the ratio. So the last 3 years, they wanted what? They wanted inflation, right? They wanted to show that things were going up, that they were getting to their mandate at 2 to 2.5%. And now they look at shelter and it's going up like 15 to 20% a year. It's weighted 45% right now. What do you think they're going to do this year? It's going to go way back down so they can say, see, CPI is coming down. There's no problems. They screw with this number all the time. So I'm going to show you what to look at instead of that. This is the problem with our supply chain in California. All the trucks are just roaming around out in the meadowlands or whatever because the ships can't get unloaded, because the truckers can't pick up a chassis. They can only work 8 hours without having to take a nap because 4 or 5 years ago we passed the electronic log delivery system. So that set the stage for what we're having with truckers, and all the warehouses are full. And so they're just driving around, waiting for something to happen. The black swan events I talked about. This is the most important slide. If you just look at one, take one away from today, this is the terrifying one that will give you nightmares tonight. So, y'all ready? Don't drink coffee tonight and stay up late. Take some other kind of medicine. So this shows what's happened to inflation. This shows the 2 Fed mandates. This is back World War II and coming out of World War II. The first mandate that the Fed got, which was full employment, came at the end of World War II. Why do you think they got it then? What was happening 1946 into 1950? All the GIs were coming home. And Congress said, Fed, we don't know what you do. You're not constitutional. You went to Jekyll Island in Georgia, and you made this thing up after 3 failed central banks already. But darn it, don't screw this up. Get all these GIs employed. So that's where their first mandate came. And then their second one came in 1978, price stability. Why would that be important? Because Paul Volcker said, I'm going to ruin the economy and I'm going to take interest rates to 20+%, maybe 40, maybe 50, right? So they said, you got to figure out price stability. So that's where they got their 2 mandates. So here's why I think we're headed to a 1970s event. We've not seen this convergence of items in almost a half century. And all the other inflation cycles, they've been little bitty, they've been one thing, they've been energy, they've been, whatnot. So the first one is, if you look at the headlines about deficit spending from the 1960s, they look just like the ones today in our record deficit spending. What were we doing in a deficit spending on in the 1960s? Vietnam War, right? So we had this run up, and when we look at it today, it looks like a joke, but for 1960s, the numbers were massive. The next thing that we had is 1971, President Nixon said, I'm not going to be a crook, but I'm going to take us off the gold standard. I'm going to ruin the dollar. We became a true fiat currency with nothing backing us. So this was setting the stage for the devaluation of the dollar and inflation when there's nothing backing it. The next thing that happened is the OPEC and the Arabs said, no oil for you guys. We'll just shut it down. And we had an energy crisis. And energy as a percentage of our economy, manufacturing, transportation, everything was much bigger than it is today. So it really crippled the United States. And it meant that we had to quit making 50-foot cars with no cup holders. So the Japanese came in and made 8 to 10-foot cars with 80 cup holders in them. Right? And it took us a decade to figure that out. So we destroyed our auto industry, we destroyed our steel industry, and we had an energy shock. Then Nixon said, I'm not going to be a crook, but I have a solution for inflation. I'm going to put price controls in effect. Nobody can raise prices. How well did that turn out? A total disaster. It just blew up inflation. And then the last thing we had was we had really bad data in Fed policy. The Fed didn't know what it was looking at. We didn't have computerized data. We didn't have private industry data like we do today. And they were just making decisions on bad data. Remember how the Fed still tells us we're data dependent? That's where this came from the 1970s. So now let's put this in context for today. So the record deficit spending that we had in the 60s, we have today. What's the equivalent of the energy shock for the 1970s today? Supply chain shock. And it doesn't get fixed in 1 or 2 quarters. This is years in the fixing that we're going to have to do here. Just the whole way we change things. I'll tell you, if you listen to one earnings report call, Procter & Gamble's this morning, the CEO there has a better insight on what's transitory and what's permanent and what's happening. And you think of Procter & Gamble, where they operate all over the world and all the products they make. This guy on CNBC this morning in their earnings call was phenomenal. Fire the Fed and put the CEO of Procter & Gamble in charge of monetary policy. This guy knows what's going on. Absolutely phenomenal. So we had the energy shock become the supply chain shock. Nixon's price controls. What's the equivalent of Nixon's dumb idea about price controls? The Fed's balance sheet. So think of what the Fed's been doing for the past 2, 3, actually going back to 2009. Anything that wouldn't sell at a price that the Fed was happy with, that would keep interest rates low, mortgage rates low, what did they do? We'll buy it at a better price. Well, now what are they telling us? We're going to curtail, and by mid-next year, we won't be buying anything on the balance sheet anymore. Okay. Have you connected the dots? If you're not buying this bleep at absurd prices, where's the greater fool that's going to come in and replace you? You think China's going to pay and give us 150 10-year treasuries and low mortgage rates? Hell no, they're not. They won't even give us chips. And even the potato chips in the store aisle, they won't give us those, or the car chip kind. So greater fool's going to come in, and we're going to go to a 3% 10-year treasury, 4% 10-year treasury, 5% treasury really quickly this year. We even had the first Fed rate hike, and the 10-year treasury in the last 3 weeks has moved from 144 to 184 yesterday. We're not even warmed up yet on this thing. So that's my concern when you look at all of these things and the phony price controls and the shocks, and none of these fix short-term. These are all long-term problems. And can the Fed fix anything? Can the Fed fix supply chain? Hell, they don't even have any intelligence. In the 20 ports that are 2.5 times LA and Long Beach, they have zero intelligence on it. That could be our whole supply chain. They're clueless as to what the merger of the Kansas City Southern Rail and Canadian Pacific Rail, and that's a big deal for you guys in this region. It means the first North American Class I railroad that goes through all of Canada, dumps in here in the Midwest, through Chicago, all the way down to the deepest ports of Mexico. We don't need the West Coast. We don't need LA and Long Beach. We can handle everything just fine. So that's my inflation slide. So here's the Fed. So if you think I'm beating up on them, I am. And when I was in the Fed, I spoke the truth often. In fact, in 2006, I did a briefing to Chairman Bernanke at the request of outgoing Chairman Greenspan. He says, you know, we've done a lot of real estate lending in the banks, more than we've ever done. Could you brief the new chairman on what's going on? So we started to have hurricanes that were running out all the property insurers in Florida, which brought into focus in 2005 and 6 subprime mortgages, and it all blew up. So in 2006, I did a presentation to him, and I said, get ready. Everything's getting ready to go to hell. The GSEs only have 1%, Freddie, Fannie had, they only have 1% capital. If they just sneeze, it's all gone. We could see 10% unemployment. Commercial real estate follows the rooftops. So if there's nobody in those rooftops, what do you think there's going to be in the commercial real estate? It's going to be bad. So I laid all this out. Governors Crozier and Morse were there, and they said, Casey, stop. Don't you know what he did his PhD thesis on? I said, I know. It was the Great Depression. And Chairman Bernanke goes, no, I want him to finish this. So when he got done, he said, Casey, you got me thinking. This is an interesting presentation, but I want to assure you, we have too many safeguards and disciplines in our monetary policy today to let anything like this happen. So I had a timeline that I laid out for him. This was in 2006, including the failure of the GSEs, 10% unemployment, commercial bank failures. I said, you could have more bank failures than we've seen since World War II. He said, it can't happen. I want to assure you we have too many safeguards. I have that today. It's going to be the cover of the book if I can ever get it finished. I promised him I wouldn't publish till after he does. So here's this Fed. Now fast forward to this Fed. At least Bernanke was an architect. He created a lot of innovative products to deal with what we had to deal with back then. This Fed has no imagination. They have no ability to figure this out. So here's the Fed where we were at. First quarter last year. There might be this thing called transitory inflation. We just made up this term. We're really smart people. Then we get to the summer. Well, it's not going away. It's transitioning along, or maybe it'll be transitory longer. We don't know what's going on. Then we get here to the fall and the end of the year, and they say, forget transitory. We never said that. It really is kind of permanent. So former New York Fed president, who I knew real well, Bill Dudley, he did a really scathing piece on the Fed last week, and he said, here's the 4 mistakes they've made, and there's no recovery from it. We're screwed. This is the former Fed, head of the New York Fed. This is the most important, probably, bank that we have. He said the first thing they did is they operationalized this whole inflationary wrong. They thought we can either raise interest rates or we can quit on the balance sheet. They go hand in hand. And either one of them that you do adversely, raising rates or pulling back on the balance sheet, it's inflationary. You're screwed. There are other ways to do it. Any bankers in the room? Nobody wants to admit it? So it's called IOER, Interest on Excess Reserves. And we've done it before. And what we do is we tell banks, we're going to make you the bad guys. We're going to pay you more for what you have, your reserves, so you don't lend. And when we want you to lend, we'll drop it to zero, almost like what it's been the past 2 years. And they could raise the interest on excess reserve and start paying the banks 4% to sit on their capital and not lend. And the Fed could say, see, it's not us, it's the banks, right? They'll wake up to it maybe a year from now. It'll be too late, but look up that one. So the second thing they said is you don't have a clue. Dudley said you don't have a clue about the labor market. You know what's happening in the labor market? The Fed and BLS look at people that work for corporations that get a paycheck. And what's happened is the millennial workforce, the remote workforce, they don't work for a corporation anymore. They're like my little company. We haven't even been picked up by the BLS. They think me and my 3 employees and my partner are watching Judge Judy eating bonbons at home. They have no clue how to pick up what's happening with the self-employed, the remote workforce. You know who does? ADP. ADP does all of the private stuff, and they work with the states and get the state data on new formations. So don't listen to the BLS on the first Friday of each month. Look at ADP the Wednesday before, and you'll know exactly what's going. What did ADP just tell us? For December, 800,000 jobs. What did the government say? We couldn't even find 200,000 because they don't know what they're looking at. They don't know how to collect the data. So they're exactly right that they don't understand the labor market. They brought this transitory thing in thinking they could, boondoggle us or whatever, that we're all a bunch of idiots like supply chain. When the president told us you all don't understand how complicated supply chain is. It's not that complicated. Really isn't. And the last one is the Fed is afraid of spooking the bond market and having a taper tantrum. And they're getting ready to spook the hell out of the bond market. It's already happened. They're not able to do their job. Paul Volcker, he loves scaring people. He was the ultimate Halloween guy for 4 years, taking the interest rates. Sometimes they'd have a meeting and raise 50 basis points, and before the next one, he'd say, I thought we need to do it again. He would do mid-cycle meetings, another 50 basis points. How's that for scary? Put those on. Imagine the market right now if we just did one 50 basis point increase. They'd freak out. Shut down the economy. So he's exactly right. The real question we should ask the Fed that none of the media will ask the Fed is what's going to be your end game. Where are you going to stop? How many rate increases are you going to do? 4, 5, 6, 8, 25? They never do less than 8. The history of this. I'll show it to you in a minute. So here's where I look for inflation. Who's heard of ENR, Engineering News Record? Awesome. You get a bonus point. She gets an extra cookie. So this resource costs maybe $100 a year, and they have a constructionomics section. They publish every month, and they get from contractors for all projects over $1 million in permit value. They get all their data in, and they look at what's happening, and they publish a construction index and a building cost index. So construction is the materials, and building is materials plus labor. Here's where we were in the spring, 4 and 6%. Here's where we were starting the fall, 8 and 14%. And we're still there at 8 and 14%. So imagine this, banker, construction loans. Costs are going up 15% a year. 2 years to build the doggone thing. Your 30% cost overrun. Oops. Who's going to pay the 30% cost overrun? And where are you going to find an appraiser that said the value of the property went up 30%? I can tell you, I'm a third generation MAI. 99.9% of them all are under the table. They're hiding. They're afraid to tell you that the value changed from what they last did it at. So we're going to have a massive problem. Cost overruns are going to be the biggest thing. They also publish an index by city. They use 20 cities that they break this down as a proxy. So the city with the most cost increases is New Orleans, 36%. Why 36% New Orleans? Because they're rebuilding from hurricanes that went into the Greek alphabet, and they need stuff more than anybody, so they're paying a premium, and it's insurance companies on rebuild. Who are the next two highest? Atlanta at almost 25% and Dallas at 22%. Just imagine that. You're in Atlanta and Dallas, and you're looking at 25% cost increases a year for the next 2 years while you build this project? A 50% cost overrun? Mr. Banker, how are you going to deal with that? I'm going to move over to workouts. I'm no longer a lender and credit committee. I'm in the workout committee. Go ahead and move right now. Protect yourself. And so for Chicago and many, if you look at the Midwest here and in Milwaukee, couldn't abbreviate that very well. Your best proxies are looking at Chicago and Minneapolis. You're running around 13%. That's on a warm day. It's worse on a cold day. So this is one. Does the Fed pay attention to this? Is this in their data dependency? Not a clue. They get nothing on construction cost inputs. And look at all the CRE lending they've done. Here's the next one. Mexico. Anybody heard of Mexico? At this time of year, they look like this, right? They're very cool. Mexico's running already over 7% inflation. Why is that so important to us? We get all of our components from Mexico. They have a lower wage rate than China. Everything that goes into a component in a car today comes out of Mexico. Anybody have a BMW that leaks oil? That's because of the Mexican component system that they haven't figured out how to make the seals right and then transition them up here. But everything that we use, agriculture, taco shells, you name it, peppers, Mexico is critically important to our supply chain. And when they're running over 7% and we have key countries, we're an import nation. Look at our balance of trade deficit. We're an import nation. Everybody we're importing from is running 7 to 15% inflation. That comes to us. And the Fed doesn't have anything in there that's monitoring that kind of stuff. All right, here's the good news. This is when you can get your cookie out. It's okay to have a cookie now. I got rid of all the indigestion. So look at what happens to commercial real estate prices. So it's called the CPPI index. Who's heard of that? So Green Street does one. Real Capital Analytics does a great one that does it by MSA. But what Green Street's telling us, and Real Capital Analytics as well, commercial real estate prices have already risen above where they were pre-COVID in 2018 and 2019. So we're recovered. Now, y'all think your prices are lower? Anybody disagree? And so look at the property types that have led. Self-storage last year, 66% increase in self-storage. Anybody have self-storage? Sell it. You don't get 2 years of this, and then we get overbuilding and all the dumb money. Just sell. I mean, the deals that I'm doing right now helping people get rid of this stuff because take the jelly beans off and rotate them somewhere else. 66% in self-storage. Where do you think the millennials put all their crap to go live with mom and dad? And work remote somewhere. That's where they put it. The next one, I know we got a few industrial people here, up over 40%. Who's the industrial guys? And it's going up 40% next year and the next 3 years because we don't have enough of it, and we don't have enough of it in the right places. We don't need any more in California. We need it Great Lakes down through the south where our supply chain, our ports, our rail, our manufacturing, all of that is. So we're building 350 million square feet a year of industrial. We could add 500 million square feet a year for the next 3 years and not move the vacancy rate off 5%. Just not going to go. And if you don't believe me, look at a few earnings reports, like look at Prologis. Prologis is coming out either this week or next week. And what they said in the last one was, we have 1 billion square feet of space and we have no vacancy. That's incredible. The biggest industrial REIT. We have no vacancy. And we're trying to add 100 million square feet and buy it. We can't do it. All right. Here's the Fed rate hikes. So here's a 10-year and a 20-year view. So here's the 10-year that gets us back, we were 2014 to 2019. It was 8 hikes from basically 0 to 2.5%, right? All quarter point ones. Go back 20 years. Go back and look at these rate hikes. Look at how steep they got. From 1% to 5.25%. 425 basis points in basically a 2-year period of time. That's what we're facing right now. So what it means is get prepared. If you or a client have a construction loan or a loan that's looking at maturing even 18, 24 months out, do the math on the defeasance and the prepayment penalties and look at it versus getting a rate today that's 4% range versus one that's at 6 or 8% living with for another 10 years. And it's very compelling that this is what I'm trying to do, is get you prepared to help your clients and help yourselves so you don't get slaughtered. Because this is the reality of what the Fed does, and the Fed won't show you any of this. They won't put it on their website. None of the Fed district banks, none of them will do this. And this is right off the New York Fed website. So, all right. Have y'all heard of LIBOR? It went away. Santa Claus came and took it. 26 of the 35 LIBOR index rates went away December 31. And the remaining ones are mainly here in the US, and we have a new replacement called SOFR. It was invented by Freddie and Fannie Mac. It's not had any history to test it. We have no idea how it functions in an inflationary or Fed rate hike environment, and the rest of the world doesn't accept it. Get ready for securitization disruption. We've only done a handful of these SOFR deals to securitize. They've mainly been multifamily, and we don't know what happens when you put hotel and office and in an inflationary environment. So you add one more of those extremities, we got rid of LIBOR, and that was London. And so who's in control of SOFR here in the United States? The New York Fed. How does that work out, right? How reliable and consistent has the New York Fed been on a lot of the issues? Go back to 2009 and 10, subprime mortgage crisis, go back to the S&L crisis, go back to the oil and energy crisis. New York is only good about going out to lunch and spending a lot of money and having high office rates. This scares the hell out of me. We went from London to New York that's in control of our most important variable interest rate. But you can track it at the New York. And look at where it is right now, 5 basis points. With everything that's happening, you don't think that, who's buying this stuff? Who's investing in this stuff? They won't tell you. All right, the jobs reports. So we got the BLS one that said, can't even find 200,000 jobs. ADP said we had 800,000. And remember what they said? We have an unemployment rate at 3.9%. Do you not think someone in the Fed would say, wait a minute, how come we only have 200,000 jobs, but drop the unemployment rate from 4.5% to 3.9%? How does that happen? Nobody asked the question. I mean, my God, I just got to shake my head. If I went back in there, they'd probably shoot me or muzzle me because they all have guns and they'd put me in the basement and I wouldn't be found again. But look for a lot of volatility here in the jobs reports. We can't get unemployment any lower than it is. We have 10.4 million job openings that people won't apply for. 10.4. The record was 11 million a couple months ago. On the quit rates, so I get people all the time that are saying, I don't want to work in restaurant anymore. I don't want to work in hospitality. I don't want to work in these tough jobs where I got to commute. I got to deal with people that hack and sneeze and have COVID. I don't want to do any of that. I want to work at remote, or I want to work at an Amazon warehouse at night and I get paid $20 an hour. Or in Atlanta now, you can be a school bus driver, $35 an hour and get benefits. holy cow, I may be a school bus driver before long, just to get the damn benefits half the day. And then I'll do this red shoe gig until I get hired in Hollywood on a late night show. So that's the problem that we've got. Look at ADP the Wednesday before BLS. It'll tell you everything that's going on, and they break it down, and it's free. So here's good news for you guys. So the United States is at 3.9% nationally. Look where you guys are. In Milwaukee, you're at 2.2%, and most of the other places in Wisconsin, you're below 2% unemployment. Anybody try to hire somebody recently in Milwaukee? You found anybody? No. And it's cold. I mean, you think they'd be like, okay, I can go someplace warm and work and get a snack or cup of coffee? So this is incredible. But what this means, more wage inflation pressures for you guys. So if you're doing property management, or if you're a banker and you got to get workout people to deal with all those construction loans, they're not out there. And so your option may be, okay, I got to get on my Kevlar vest and I got to go down to Chicago and try to hire somebody and get them up here where it's safe, right? My son Luke, I'm in a safe place today. All right, I got a new tool for you. Who are the CCIMs in the crowd? Know who they are? Have a friend of one? So we've worked really hard at CCIM. They have an entity called CCIM Tech, a sub-entity, and we've introducing a lot of new products. And one of them that I was involved with, we had a drinking game for 3 months, and we tried to figure out what are the 10 most important economic variables that we could put into an index and it would tell us what we need to know. And so after 3 months of drinking, we figured it out. Now, we were really serious about it. Here's the 10 metrics. We back-tested it through all the recoveries, all the recessions and whatnot, and we were almost perfectly on spot. So when you can go back multiple recessions, multiple recoveries, and test what you're putting together as an index, so we didn't overweight it. We put some employment, some business confidence, some commercial real estate, some inflation stuff. Here are the 10 metrics, fully transparent, unlike the Fed. Here's where it comes from. I'll write the narrative each quarter. We'll put it out to you. You can send it. It's free to your clients. It's free for your media, free for your chapter websites. So it's called CREPI, Commercial Real Estate Performance Index. Don't confuse it with the next one I'm going to tell you about called CREMI. Because CREPI, like a crappie fish, is a good fish to catch if you do lake fishing, right? To go catch a bigger fish. So CREPI is good, CREMI is bad. All right, here's CREMI. How many of you have heard of CREMI? That's great, really good. So this is produced by the Fed. So when I was at the Fed, I built a thing called Real Estate Market Spotlight. We used lots of private industry data, 180 markets. We did a green, yellow, red report with Moody's, and we actually told the truth that was going on. And we actually were influential in policy matters. Well, the economists are all PhDs, and they've never bought a car, bought a house, been to the grocery store, knows how things work, don't know what currency looks like. They've never seen it. They just have a Fed credit card. So they said, the first thing we're going to do is we're going to create a new index, and green and blue are going to be bad. So how many in commercial real estate and banking have associated green and blue with an improving trend, a good market, and a good thing? They said, you all in the industry, you're idiots. We're academics. We're changing the colors. Green and blue is bad and downward trending, and orange and yellow and red, that's good. So first of all, your mind's blown when you look at this thing. You're trying to correlate. So I'll share with you in a minute on population growth. The Intermountain region from Boise, Idaho, Salt Lake City, Denver, Arizona, they're booming. The Fed said, nope, they're downward trending. We're changing them all green and blue. Are you kidding me? Then look at the southeast here. I was just down in Miami, which is just off the charts. Growth and whatnot, no sublet vacancy, everybody's going back to work. They have almost all of the southeast as green and blue. And the yellow and orange, which they said which is improving, you know, they're like some of the most secondary, tertiary markets in the country where they might have 5 jobs, not 5,000. And the second thing that they do is they take CoStar data. Anybody from CoStar here? Know what CoStar is? Okay. CoStar data and Moody's Analytics data, they reinterpret it. They won't tell you how they're reinterpreting it, and they're coming up with this garbage. So I've been working and communicating a lot with Moody's and CoStar that what the Fed's putting out is a 180 degrees from what they are on their good raw data, and they need to put a cease and desist on them. But this thing is absolutely horrific. So don't look at it. Bankers, if you see it in any appraisals, fire the appraiser right away that they put it in there. So what I do when I see something like that CREMI index, so I'm working on more and more branding and stuff. So I've learned, I grew up in Colorado, and I've been in the South over 40 years, and I've learned, any of you been from the South or know the South? Have family in the South? There's 2 things you really need to know. So if you move there and you buy a house, make sure there's a pineapple on the mailbox because that's a symbol of your welcome here. And if you don't have a pineapple, trick-or-treaters won't come to your house. The mail won't get delivered. They don't think you're very welcoming. I still don't know how they picked a pineapple. Why not okra or something like that, or grit, put a bowl of grits on there. The second one is the polite way to call BS on something is to say barbecue sauce. So last year, we started co-packing our own barbecue sauce. And if you send us an email, we're working on the 3 ounce or less so you can take them on an airplane with you. I would have brought some today, but all we have are 16 and 24 ounce bottles. So on the back of the bottle, it says, this barbecue sauce has no calories, prevents COVID, cures cancer, and about 2 other things. On the front label here, it says, I'm basically the Red Shoe Economist, and I'm calling barbecue sauce on all of that. So what I recommend is you get a bottle from us, and you get something across your desk. Brokers, you get a really insane offering or list price. Just take your bottle of barbecue sauce out and sprinkle a little bit on it and give it back. All done. And you'll feel so much better, right? So if you see in my LinkedIn post something about I'm calling barbecue sauce on it, I'm calling BS on stuff. So that's what that all means. All right, now let's talk about something fun. We're done with inflation. We're done with the bad news. We're going to talk about really what's driving the other half of the economy. And my theory is, here's the number one question you need to have for this year and next year. Where can you outrun inflation? If you don't have an economy that can grow 7% or more, you're not going to be able to keep up with inflation. And so there's a lot of markets, New York, California, the Northeast, they're at negative numbers in terms of GDP and population growth. Illinois was one of only 3 states to lose population in the last decade in the census. So they can't outrun inflation. Everybody's coming up here and creating inflation for you guys, right? Trying to get out of there. So every January I get really excited. I get my late Christmas present. The moving companies issue their moving reports. Where did everybody move last year? So U-Haul and United Van Lines. And so here's the U-Haul one showing where everybody went. They all went south, Texas, Florida, Tennessee, South Carolina, Arizona. Or they went to the Intermountain region, Colorado, Idaho, Utah. But look at Wisconsin. You ranked number 13 in the country for the most net move-ins. That's a lot of Chicagoans that moved up here, right? And they would have moved more if they could have got some more U-Haul trucks down there, but they all were stuck up here and they couldn't get them back. So this is really good news. You're one of the places, I think, if you're in the top 15, you're where you can outrun inflation. You're getting good growth. Home prices are going to continue to go. Demand's going to be here. Workforce is going to be in demand here. So this is really good news for you guys. Here's the United Van Lines one. And so in Wisconsin, I don't know where they were. They must have been frozen still somewhere, or with COVID. They ranked you guys number 34. Now, I'll tell you the difference between U-Haul and United Van Lines. United Van Lines does corporate moves. If you're the government, if you're a big company like Procter & Gamble, Coca-Cola, Ford, GM, they pay for United Van Lines to come do your corporate move. So you're getting more U-Haul type movers, young millennials, first workforce, people that aren't in a big corporate environment, that are doing that. So United Van Lines, it's really relevant for places like California and New York and maybe some of Florida. So I wouldn't worry that you ranked number 30, 34 there. All right, the census data. What did the census data tell us? So they told us Intermountain region, the South, and look at the Midwest. Look at how steady the Midwest is. And you'll see in a minute, I'll share with you some of the companies like Generac, that are expanding and creating jobs and manufacturing here. But you look at Wisconsin, Michigan, Iowa, Indiana, Ohio, it's a steady 3 to 5%. And let me tell you, Utah, Salt Lake City, would trade your 3 to 5% for their insane number one, 18 or 19%. You know why? They can't manage the growth. It is so out of control. Nobody can find a place. Apartment rents are up like 25 to 30%. Home prices are up 40 to 50%. It's almost too much good. And so what you guys have, a lot of companies are discovering, is remote work can be there. It can be affordable. You have good logistics infrastructure. You have airport infrastructure. I did a direct flight from Atlanta into Milwaukee. And when I told people in our office in North Carolina that I was able to do it, they said, "You're kidding me. You're making that up. There's no direct flights to Milwaukee." I said, "Wake up and smell the snow." And it's on time, and there's no problems. So this is consistent with the census data. How many of you have heard of ULI or are a ULI member? Right? Every year they produce an emerging trends report. Their 2022 one came out right before Christmas. It's one of their best reports ever. They break out things like an overall ranking, then where investors want to go, and where development is likely. So you can see the dominance of the South here, but as you get in there, you can see where you rank. Here's the most important thing here. Look at development. No city made a strong ranking by any developer for strong development potential. Why? You can't budget a project. You can't find the workforce. You don't know when you're completed. You can't talk to the banker without lying to him about when this thing's going to be done and what it's going to cost. So this is the first time in the history UI's been doing it. I was with them at Equitable when we first started this back in the 80s. This is the first time we've seen no strong development potential. And it's because they can't figure the cost out. It's not because the demand's there. It's if I want to build a new apartment, what does a new apartment cost? Who's multifamily in here? What does a new apartment cost to build here? In most of the country, it's about $250,000 to $300,000 a unit. My God, that's what a house costs. That's what the median price of a house was 3 to 5 years ago. And if it's going to go up 50%, so you get 2 years of 25% increases, how in the world do you finance that, underwrite that, appraise it? You think an appraiser is going to give you credit for a 50% increase over 2 years? Man, I'm a third generation MAI. I can tell you I've never met one. Not even me that would do that. All right, so let's talk about what's happening here and some of the things you've got going on. So you know about Nexus Pharmaceuticals. And what I put up here is what the U.S. most needs now, your state is expanding and producing. And then this is going to be very strong for your economy and all the trickle down. Pharmaceutical, do we need pharmaceuticals? Right, what did we learn during Trump and the tariffs and then into Biden? Where are all our pharmaceutical stuff? Where's all our protective gear? Where's all that stuff made? It's in China. And they're only going to give us the stuff that works on the last virus, not the new virus, right? That they're putting together with the bats in there. Did I kind of reveal my ideology? Anyway, I do think they created this damn thing, and I do think there was some crazy stuff going on here. So this is very good. Generac. How many of you heard of Generac? As we have more climate change, as we have more natural disasters, I mean, in the Gulf, in New Orleans, they went all the way to the Greek alphabet. We'd never been to the Greek alphabet. So we're going to have, more Colorado on fire, Texas on fire, all these disasters. Us in Atlanta, I've got a Generac system at home because it's only maybe a few days a year that we lose it. But, when you have kids, you can't even lose power for an hour. You actually have to communicate with them if you lose power for an hour. And then if you have millennial daughters and you got to sit down and have a conversation with them that they're home from college, oh my God, no, I got to go find a flight somewhere. So anyway, so this is very good. So think about these things that you're making that are expanding, that's the growth behind your economy. It's what our country needs right now, right? If you guys would just put a chip plant in here, and not a Lay's potato chip, but a microchip plant, we would really love Wisconsin. All right. So every year, I'm a counselor of real estate. We put the top 10 issues together. And I've been doing this since we started it, and I get tagged because I do a lot on adaptive reuse and logistics. And so I'm going to talk about just 3 here: adaptive reuse, housing, and logistics. All right, adaptive reuse. So we issued a new paper. We did it for the Miami Realtors, Florida Realtors, and CCM chapter. I did a follow-up to my first paper 3 years ago on adaptive reuse. We called it Making Bright Brighter. It's the neighborhood approach. So if you have a dead mall, if you have a blighted area, don't think about one-off adaptive reuse projects. Look at a whole neighborhood and look at what you can do. Because developers don't want to take the risk that local government's going to say, local government, they're like corporate in-house counsel. Any corporate in-house counsel here? They're taught how to just say no, right? If you make a decision that says yes in corporate legal counsel or in local government, you get fired, right? So just say no. Nike says just do it, and government says just don't do it. So this goes through here, looks at the approach, and we highlighted several areas here. The green space, they're taking this thing called the underline, and they're connecting the poorest, most divided areas that interstates divided us in the 50s to the 70s, and they're reconnecting them through greenway space to the most affluent areas. And so it's helping this divide and all this division that we have in our country. So you guys do it. This is my favorite, all-time favorite, Wisconsin and Milwaukee Adaptive Use Project. Some of you may be familiar with this. This was an old candy factory. It's called the Bricks Loft Apartments. Anybody involved with it? Live there? Nobody there? Have a kid that you sent there? But really, they did all kinds of cool stuff here. Even look how they did the bikes. Instead of throwing the bikes and the scooters all over the street for everybody to trip over, they figured out how to put them up, right? But this is a really good, it's a very successful project, and you've got many more. All right, housing. So we have a real problem. If you can't build a new home for under $300,000 a year, you can't do entry housing. So here's one of the solutions we're seeing is for rent subdivisions. Y'all have any up here yet? Need to get a bunch of them. And they're very, very profitable. This is a company called American Homes for Rent. They'd be one of my stock picks. These are places they're building all over the country. So they're in Chicago. They're big time down here in Florida and Texas and whatnot. So they go in, and where local government says, we don't want no apartments, they create too much services. They say, okay, no apartments. How about single family? Oh yeah, do that. So they take a weird piece of land that they buy cheap, and they build houses. And then when they're all built and pass inspection, they rent them up. And most of them, they're looking at 97% plus occupancy all over the country, not just one or two places. And so now if you're a millennial and you don't want to live in the city and you want to work remote and you need an extra bedroom for your snoring spouse or to have an office, you know, you can have that. And the rents on these things are like $1,800 a month for a house. And they're in good school districts, they're in good neighborhoods, and the local government's been snookered by this is how you get multifamily into really good areas rather than building apartments. So this is one, I highly recommend you look at their strategy. It's a great opportunity for brokers or anybody kind of young or new to the broker side. You're looking for a niche, this is one. You can retire in about 3 years doing deals to American Homes. There's 7 of these type companies. They don't know how to do all the site selection. CCIMs, the site to do business, all of that type of data. This is incredible. They love all of this stuff. So it's a neat opportunity. All right, multifamily. So anybody do multifamily? All right, a couple out here. So it's going to be just fine. This year, we will produce more new apartments. We'll deliver more new apartments, 425,000, going back to 1987. So you say, oh my God, too much supply? No. 148 of the nation's 150 largest housing markets, or MSAs, have 96% or better occupancy. There is no inventory. The challenge we have is don't overbuild the luxury, right? How do you figure out how to scale and build when you have these kinds of cost increases? That's the big challenge. But multifamily is not going to implode. In fact, more that can't buy homes are going to be going downstream. So think about when things get too well, when office rents get too high, what do office tenants do? They move out of the Class A and they come down to Class B. That's kind of what's happening in housing. I can't buy a house. I don't have the deposit. I have student loan debt. I don't have a credit score that will get me a loan because the banker doesn't like me. You don't like anybody, do you? Bankers are just grumpy. I've been one all my life, but you know, we have to be grumpy because everybody lies to us and then we have to make the loan, right? So anyway, multifamily is going to do very well. And especially in a market like this, because everybody's moving out of Chicago. And they're used to rents that are a lot higher. So even if you raise yours 20%, that's okay, right? They're used to like $84 a square foot for apartment rents in Chicago, right? I'm joking. But it's well over $5 a square foot. So multifamily is going to do just fine. Logistics. This is the big story. So a decade ago, I promulgated this thing called the Golden Triangle. Now people are picking up on it. The Golden Triangle is the area from the Great Lakes and up here down to Texas and across all the Southeast. Why is that important? 70% of the U.S. population lives in or east of that Golden Triangle. Number 2, 80% of all new manufacturing and corporate expansions in the last decade have been right here. They're not out here. 2/3 of our logistics infrastructure, Class 1 railroads, ports, remember the 20 around the Gulf? They're all right here. And the new Canadian Pacific, Kansas City Southern, goes right through here, right through you guys, all the way down into the Port of Mobile in Alabama. This is the new supply chain. This is where the investment is. And if you look at go to Amazon's website or go to FedEx and look at what they've built, what their inventory is, and where they're adding, 85% of it is right here. That's the supply chain. And we do manufacturing so we can fill those empty containers up and send them back out to Asia and Europe and places like that at a lower cost. when it goes back from Chicago to LA and Long Beach, nobody wants to move an empty container across the ocean. They don't get paid for it. It's very expensive. Here's the Class 1 railroads. The rail story is incredible. So these are the Class 1 railroads. Here's Union Pacific out here, Burlington Northern, Santa Fe, Warren Buffett's choo-choo train. He only bought things he liked as a kid. Dairy Queen, trains. He buys toys. All of us boys, we buy toys. We invest in toys, cars. Look at the Mecum. Anybody watch the Mecum auctions in Kissimmee, Florida this weekend? They had cars selling for over $1 million. A Camaro that cost $3,000 in the 1960s and 70s were going for $300,000 to $500,000. You know, just go buy a classic car. The IRS doesn't pick up on it. They don't track VIN numbers. The auctioneer holds the title and the letter of credit and the exchange. You make $100,000, IRS doesn't know. That's better than Bitcoin. So these are our Class 1 railroads right here. So here's Canadian Pacific, and here's Kansas City Southern. Here's the merger of the two. The other thing is pay attention to the ports. So everybody thinks there's the West Coast in LA, they think there's the Gulf Coast, and they think there's the Southeast and the Atlantic. Who's heard the term America's Fourth Coast? I hope next year, everybody's heard of it. So this, your Great Lakes ports, right? They account for 30% of our GDP and 40% of our supply chain. And you won't hear a word out of Washington, D.C. about that portion of our supply chain. Or the Fed. The Fed doesn't even know there's a fourth coast. They think I'm making it up. We have to have them up here. So remember I told you pay attention to earnings? Here's the Prologis earnings release. They have a new one coming out. And what they said in the fourth quarter for third quarter, they said, look, we have almost 1 billion square feet, 995 million square feet, and we are essentially full up. This is the largest industrial owner in the country, and they go across to Europe, and they have all kinds of perspective, and they're saying we're full. So if you're doing warehouses, just have the latest Prologis earnings handy to put in your package. That's all that needs to be said. These kind of numbers, this is why we can build 500 million square feet and not have any problems. All right, office. Anybody do office here? Nobody wants to admit that either? All right, there's one. All right, so here's a story. I'm going to give you a tool to look at. So Castle Systems is a company that made the key card system that we all rely on to get in and out of our buildings. And guess what they did as part of licensing that software? They get to know what the hell you're doing. They're worse than Facebook or Amazon. So they know who's coming and going to the office. And what they're telling us is not even 40% of us are going back to the office. And the most is in Texas. Austin, Houston, and Dallas have over 50%. The worst are the West Coast and New York. I'd have to pay more data to get down to your markets, but anyway, Milwaukee, you're probably in that 40% range. What I do when I travel, and I did it today when I came in from the airport, I had the driver take me through some apartment communities. You know what I saw in the apartment communities? The parking lots were full. And you know what I saw when I drove down around here before we got to the hotel? Half the parking was empty downtown. So that kind of tells me, anecdotally, don't you wish the Fed would do kind of some of this stuff, you know? Just, you know, go touch it and feel it. I wrote a piece for CCIM this summer talking about office and the future and the outlook. And the other metric besides that I looked at was sublet numbers. So I don't know, I couldn't find good data on your sublet numbers. But look at, like in Atlanta, we're 50% off on the rent and 25% of the space in downtown, midtown, and Buckhead markets are all for sublet. Coca-Cola, Truist Bank, every major Fortune 500 company. And where are they going? They're going to the suburbs. So Real Capitalytics is the only entity that breaks out office activity by downtown and suburban. And what they told us for last year is CBD office buildings dropped 4% in value. Try about 15% by this time next year, right? And suburban, up 15%. Companies, and I'm doing consulting assignments and search assignments where companies are saying, here's our employment workforce database where they live. Go find me old 1980 vintage business parks or closed branch banks that I can put that to work and lease those or buy those to put my remote work employees in there for team meetings, client meetings, or whatnot. Suburban office, it's better than Bitcoin, It's better than an industrial warehouse. If you can get your hands on suburban warehouse, it's going to be like that sign in your subdivision where it says coming soon, a house for sale on Friday night, and on Sunday you have 10 contracts. And the last one is, I'll pay $1,000 more with no contingencies. That's what's happening with suburban office space. So if you're at all worried, go suburban, get the hell out of downtown. All right, here's your Colliers. Was anybody from Colliers here? So yeah, there you go. So here's the Colliers report. I don't think you have your fourth quarter report out yet, so I apologize if I didn't find it. But here's what worries me. You've recovered from some part of negative absorption. You got positive, but look at your under construction, and probably a lot of this is what Northwest Mutual's building. It's probably 3 buildings that are causing most of this. But you have over 500,000 square feet to absorb, and honestly, probably you're averaging net less than 200,000 square feet of absorption. And this is all pretty much urban CBD stuff. So that's going to be your real challenge, is how you guys get through the downtown market. Your suburban stuff, I think, will do very well. But talk to the Colliers or Cushman or whatever people about that. Retail. All right, who does retail? Okay, it's good. I'm going to give you some good news. It's not all terrible. Just don't sell them all, unless it's for adaptive reuse. I look at the headlines. Believe it or not, we had 17 IPOs last year in retail. It actually wasn't so bad. Retail earnings, we have to understand what's going on. So last October, we had the biggest increase in retail earnings in a month ever. It was at 1.9%. Why'd that happen? Because the media scared the hell out of us and said there's going to be nothing to buy in November and December, so you better get it now. So we all advanced our November, December purchasing into October. What just happened with the December retail sales? They went negative. Why? Because everybody already bought everything in October. But if you look at October, November, December last year and averaged it, and look at October, November, December this past year, what you'd find is you're up about 3%. We've just shifted when we're buying. The other thing is, we're not buying more. We're paying more for the same stuff. Look at your grocery bill. All right, look at anything you're buying. And so that's retail, but I'm going to give you the really neat piece. Where retail is just crushing it right now is where you have what's called influence density. So Tim Blair, our last CCIM president, he came up with this term. He's a retail guy. And what he said was, where you have density of housing, and that housing has good household income and wealth, retail's cranking. And they're not buying stuff. They're doing services. Pet grooming. Do you know that pet grooming and pet boarding and daycare places aggregated was the #1 retail leasing category last year? Everything's gone to the dogs. All right? And so look at what's happened with strip retail centers. They're up 4% in value. And if you go and you look at a strip center that's near a Walmart in visibility from it, or a grocery store, one of your dominant grocery stores, what you will see is that strip center is full with services, not good selling, and a banker won't give you a loan on it. Why? Because the credit policy manual says it has to have national credit tenants in there at a certain percent, or we don't lend. We've got to rethink how we lend on retail again, because we're not going to have credit tenants. We're not going to have national names. We're going to have services, and it's going to be like Prologis. Prologis wants no one with more than a 5-year lease because they want to churn and raise rents. Right? So they want that risk. And in strip retail, if you've got influence density and you look at that density around the mall or whatever, and you look at the wealth there, you'll find those strip centers are doing just great. So that's your secret sauce on retail. My last slide. Every year I publish the naughty and nice ELFs list. I've been doing this for 13 years. And the Federal Reserve has made the top of the list almost every year. And I think they will until I die. And since I'm in control of it, I probably can guarantee that. So I had inflation at the top, but here's one I want you to pay attention to. Who's heard of proxy advisors? So these are companies like ISS and Glass Lewis, and they get to determine whether companies can merge. They're a group of Harvard elite people that say, we are going to go so far left on ESG and DEI that if we don't think you meet the test, you don't get to merge. So our REIT, Monmouth, a successful 53-year-old REIT with a diverse board, great assets, producing almost a 6% dividend, they would not let us merge with EQC and Samsale. And they wouldn't even meet with him to talk about why he was interested in buying them, because he's selling all his office, or sold most of them, and he wants to put that money to work in industrial. And they said, He has an all-white male board, and he drops the F-bomb, even on analyst calls. He's not ESG compliant. He never will be. I said, well, wait a minute. But we're bringing a whole different composition because he was going to keep a third of our directors, our female, our minority, all that type stuff. Wouldn't even meet with us, but that's not enough. On the math that they did on us and our numbers, they made a $3 billion math error. It was only a $5 billion transaction. They only missed it by 60%. They refused to retract it. And here's why these proxy advisors are so powerful. Over a third of our stocks today are held by ETFs, what we call robot traders. And so they don't have a real person, they don't have a real board, so they just turn these proxy advisors and say whatever their opinion is, that's what we are. So we needed a supermajority of 70% to merge. And we didn't have it because we had 35% of our stock was held by robot traders. And they all just voted the way these guys did and the deal went down. These guys have so much power. The SEC's tried to rein them in for 20 years and can't do it. They are destroying our free capital, public capital markets because they determine on their agenda, right, whether somebody gets to merge. It is incredibly scary. You talk about socialism, the end of capitalism, the end of capital formation. These guys are, I think, more scary than the Federal Reserve. Very serious. So you need to pay attention because you have pretty good public companies. On my nice L size, community property price increase. Everybody that has commercial real estate, it's going up, right? This will go up more than inflation. If it's not, then your property values aren't going to be able to be sustained. So if expenses go up more than rents and cap rates go up in response to higher interest rates, you got to have a value correction. So you got to be where there's 7% or more growth. And we know it's not going to be Illinois or Chicago. Chicago, Mississippi, and West Virginia were the only 3 states in the last census to lose population. Think of that on that side. The other one, transportation, logistics, and then Zoom towns. I look at Milwaukee as a Zoom town. You're a great secondary market with great infrastructure, great airport. Your utilities function. I went to Jackson, Mississippi recently. They have a worse water system than Flint, Michigan. When I got in there, the power went out at the airport in the whole town for almost the whole day that I was there. They had to bring a manual jetway to let us off the plane. The water had been out. We could only get bottled water. This is the South. This is Jackson, Mississippi. It's worse than places like Flint, Michigan. So when you think of new inventory and the check marks and all that you have, you're a very attractive Zoom town. Generac and the pharmaceutical industry wouldn't be coming here and putting the capital investment if you weren't. Your Northwestern Insurance Company wouldn't put a new headquarters building up here if it weren't. So you got all the right ingredients, so you should be really proud. If you could just warm it up a little bit this time of the year, I'll do my part to heat things up. And this is a little bit about my little company. We're only a little over a year old. We are a majority woman-owned business. I'm the only white, gray-haired male in the whole company, right? So I set that out if I was going to start my own company. I do believe in ESG. I believe the fundamental concepts, but how it's executed is horrible right now. So we're all there. My business partner is Beverly Keith, who's a CCIM. Every one of my employees are CCIMs. I need skill, I need competency, I value professionalism. So any of you that are working on designations or professional, get it done, because it does matter, even to small companies like us. So it was great being here. Hopefully I gave you some good ideas. I don't think I revealed my political ideology or my color orientation or attire. I used to be a conservative banker. I looked like this gentleman over here a few years ago. And I go to Alabama and I get screwed up, and then I go to Miami. So I don't know, we have time for any questions, or how are we doing on time? Yeah, and I'd be interested on the downtown stuff. You know, I liked what I drove around in, but you know, you do it. Look at parking lots. And I try to look at just common sense things. Why are all these garages and parking lots half empty, and why are all the apartment parking lots full? And we have to break that cycle to get these assets back going. But Chicago's going to help you with that. They're dumping out. They're coming here. Yes, sir.
I think I know where you'll stand on this, but I mean, a lot of communities now with rent control, you know, as they're
rent control never works. It restrains supply, so prices have to go up, those that have it. So it's kind of one of those things that, well, it seems like it should be a good idea. It's like Nixon with price controls, right? It can be a short-term stopgap measure that doesn't solve anything long-term. What we've got to do is we've got to completely rethink affordable housing. Things like for-rent subdivisions, things like manufactured housing. Who's been to a modern manufactured housing community? So the sister REIT to our Monmouth is UMH. We work with Warren Buffett, Berkshire Hathaway. Do you know you cannot get a loan from FHA, Freddie, or Fannie on a manufactured home? Why? These things have built to better tolerances than an apartment. They're built to run down the road at 70 miles an hour. They don't need repainting for 30 years. They're built in a factory-controlled situation. And when these communities are built, if you go look at what's being built, and these aren't trailer parks and pre-HUD covenants anymore. And you can put them nicely out in the suburbs. You can put walls around them like we've done with self-storage. They put self-storage in there so they can put all of their stuff in the front yard in storage. They put HOA covenants. So if you have more, in our UMH ones, if you have more than three 911 calls to your house, unless it's for a heart attack, but it's crime, disturbing the peace, whatever, more than 3 in 1 year, you're out. And they'll either buy, if you own your manufactured home and you can't move it, they'll pay to move it. They'll just get you out, but we're not going to have that. They put police precincts in there. They put Dollar Tree stores in the out parcel in the front so people can actually get milk and beer or whatever, you know, instead of, because they're usually a little bit further away from the services. They run shuttles to the factory, to the schools, you name it. These things work. And the total end cost for the manufactured home lot plus the home is under $100,000 today. So you can do 3 of those housing units for one stick-built apartment. That's how, when you look at factories, when you look at the suburban, when you look out there, this is one way. But we're going to have to look at, there's many more. There's tiny home. We now in Atlanta have 2 tiny home subdivisions in the city where, you know, the millennials think that's cool. They don't need all this stuff. They're minimalist. But how do you safely have them connect to utilities and all that kind of stuff? We're going to have to rethink it because the cost to build a home, you know, you're over $300,000, $350,000. What do we do with this whole millennial generation? I'll tell you what's going to happen if we don't deal with it. So the millennials are going to hear mom and dad, the baby boomer mom and dad, having a discussion about a reverse mortgage at dinner. They're going to be over visiting, and they're going to say, what's a reverse mortgage? When mom and dad explain it to them, and later that night the millennial says, oh my God, that means the last asset that mom and dad have, they can basically tap all the equity out of, and we'd be left with nothing. We need to pass euthanasia laws more quickly than cannabis laws and put all the baby boomer dads, moms, dad down. That's what's going to happen if we don't. This generation, the millennial generation, is bigger than the baby boomers. They can outvote us. They want our capital. You know, they want to travel. You know, they don't want to work like we did, 70, 80 hours a week. It's more. They saw mom and dad work 70, 80 hours a week and commute and do all this stuff. They said, not for me. So if we don't address it, they're going to tell us what our future is, and I don't think it's very good. And I don't think we'll get that reverse mortgage. Just don't think it's going to happen. At least my 2 21 and 27-year-old daughters have said, we now know what it is, Dad. We're watching. I said, that's okay. I already put mortgage lock on the mortgage, mortgage protection. But we got to find solutions. And it could be that we also need things where, like we have a gas tax. We might have an affordable housing tax, right? That says we will go in places that are shut down, or, you know, an old factory or an old mall, and we put that money, we put some of that to work. You know, maybe it's 1% on something, you know, boat sales or, you know, cannabis sales. How about that? You know, that's pretty good. 2% on cannabis sales goes for affordable housing. I'd go for that. That'd work out, right? We're going to have to rethink this. And unfortunately, I don't think we have any intelligence at all, Freddie, Fannie, the Fed, or Washington, to really figure out affordable housing. But if we don't, it's not going to be pretty for the baby boomers.
How do you see ESG movement affecting commercial real estate long term?
I'm scared. I wrote a piece on this 2 years ago. The idea is good, right? We all want a good environment, right? We all want social diversity in our, whether it's our neighborhoods or, I mean, it's not a bad thing. You know, I grew up in Denver, you know, where we just had just about everybody in the community, in our neighborhoods and whatnot. So when I came to the South, and saw these KKK marches going on and people driving with the rebel flags or whatever. And I called my dad and I said, is there a war going on down here? Because out west in Colorado, they only taught the Civil War for one day in all elementary school. But we did a lot about Western issues and whatnot. So I had no idea what the hell was going on. So, you know, when I came down here, it was kind of a culture shock into the South, into Atlanta. But it is being executed as badly as these proxy advisors. And so when you put these mandates and put that you've got to basically have a certain ESG score. So these same proxy advisors, ISS and Glass Lewis, do you know they issue an ESG score for every public company? And you don't have one damn word to say about it or rebuke it. So when we had Monmouth, we got these terrible scores because we were in warehousing, industrial with diesel trucks. And when 3 years later we got them to see that our headquarters was in an adaptive use rehab that we did at Bell Labs, where more patents were made in New Jersey and whatnot, and the biggest solar voltaic roof, that every building that we built in the last 10 years for FedEx is LEED certified with solar power. We net return electricity to the local community. We have multiple refueling stations. We have LNG gas, hydrogen, and electric truck vehicle on every one of our projects that we do. And when we showed them that, they said, that just can't be true. We said, get off your asses and come here and look at this stuff. And we finally got them to do a tour. And we finally, over 3 years, got our ESG scores up, or we wouldn't even had a chance at this ILPT. The people making the scoring, making the decisioning, telling you what's a good ESG real estate investment, they don't have a clue. And when you look at the performance on these ESG investments in commercial real estate, it's horrific. Right? Because they put so much emphasis over here and not on return to the investors. And you can do both very well. But don't leave the real estate community on the sidelines, because we understand a whole hell lot more about this. There's another entity. Who have you heard of Just Capital? This is a ESG DEI group where they're looking at companies. And they're not only just looking at their ESG score, they're looking at what they do with their profits and their revenues. So if they give to the Boy Scouts and the Girl Scouts, that's bad. You need to give to the LGBT Scouts. Well, I'm not aware of an LGBT Scout troop or whatever in the country. So they're beginning to tell companies where you can deploy your profits, what charities you can give to. If they don't like the charities in your local community, let's say you're in a Jewish predominant community and you give plenty to there, or a Catholic, and they don't like that. They want Muslim. They give you a bad score that nobody understands. They just say, if I'm BlackRock or I'm Wall Street Capital, I'm not giving you a loan, I'm not investing in your fund, I'm not investing in your REIT because you have this horrible score. And so everyone in this room, you need to be aware of, if you don't have an ESG tab on your website, get one tomorrow. Start thinking about everything you do, every project that you sell, that you engage in, and how it has some part of an ESG positive story. Because I'll guarantee you there's one there. If it's LEED certified, or it's an adaptive reuse, or the tenant in there is a good nonprofit, you need to have that on there, because these folks over here, it's almost like North Korea dictator. They're lobbing missiles at our industry, and we are very, very far behind it. That cheer you up? It's scary. I mean, proxy advisors, all this goes together. You know, they're all intertwined, and they have one common denominator. Anybody here from Harvard? Harvard is at the root of all this stuff. All of these poor execution. Good ideas, horribly executed. So I'm not a fan. I don't get invited to go talk much in Austin.
One final question.
In one of your first slides, you talked about potential black swan events. Give us a sense of what you think would be the most likely black swan scenario.
I think it's cyber attack, like what we had with Colonial Pipeline. Russia, China, North Korea. All of them have the abilities. Shut down our utilities. They know our satellites in outer space. This crazy North Korea guy says, I'm not going to worry about trying to reach the United States with a missile. I'm just going to take out your primary communication satellite. And you can go on the web and you can map every satellite that's orbiting and know which one is our primary military one for communication, which one goes to NORAD, which one is Sprints, and now we've got all this private space stuff that we're launching. And so all that's in public filings. everything that these, billionaires are doing, going to outer space up for a few minutes and come back in, all that stuff, their technology, it's all public. And so they've captured all of this stuff on us. The other thing is they know what critical commodities we can't live without. And they're in control. China has been buying up rare earth minerals. So we need all these batteries in our cell phones. They've been buying it up in Canada. They've been buying it up in Africa. They have something like 85–90% of the world's supply of rare earth minerals that we know today. And we've done nothing to develop those and mine them or see where we might have them. And so we could suddenly wake up and someone could be producing 500,000 new electric vehicles, and it'd be just like chips. There's no rare earth minerals to run your batteries. And so I think it's cyber attack, and I think it's control of key commodities in supply. Look at Toyota. I don't know if you saw last week, I think it was last week, Toyota surpassed GM as the largest car manufacturer in the world. And you know why they did it? They still make all their own chips. They control them, and they won't sell to anybody else. You look at China with Kia and their electric company and what they could do. They could crush Tesla like a cockroach, Mr. Wonderful. Step on them like an ugly cockroach they are. We have totally underestimated what we've done in exporting control of everything we need to operate. Military, consumption, businesses, you name it. And if we don't put on fast track how to get things back to America, what are the top 10 things we need to make back here in America today? I'll give you one last example. In China, the third largest port in China called, it's got a weird name, I'll forget in a minute, like Delirium. So it's the third largest. They had 2 COVID cases picked up on in their port. They shut down the whole million population area. And in China, all the manufacturing occurs on the port. You know what's made there? Intel chips. What we need most is at a port in China that they can shut down because of 2 COVID cases. Those are the black swan events that we just aren't doing the basic domino connecting anymore in our institutions, whether it's the Fed or it's the Labor Department or even our universities. They're not connecting all the dots. And all of the stuff that we're developing and doing at our universities, we're allowing so much of that to flow out to people that hate us and want to end capitalism. And so that's my concern. Think of Colonial Pipeline last summer. Imagine if they just suddenly turned off all of the utility grid on the East Coast. Or they shut down sewer plants, water lines, shut off pharmaceuticals that we're not ready to do and produce. That's what concerns me. And I don't think it's going to be someone dropping a nuclear bomb on us. I think China is going to continue to put pressure and act up with the current administration over Taiwan. In Russia, I truly believe they're going to go ahead and make an attempt to invade Ukraine. And what are we going to do? What are we in NATO going to do? And I don't think we as the United States are going to step up. So is NATO going to have to go alone? Is Germany going to shut off the pipeline and the revenue to Russia? I don't know. Those are the things that, I stay awake thinking about that. Forget the inflation piece, because you want to see 7% inflation go to 30%. One of those events could make that happen. But other than that, everything's going to be cool. Make sure you still have a manual snow shovel, so if you can't get electricity to make your snowblower work, make sure you have a pre-catalytic converter car that has no computer. So I still have my original 1967 Mustang, just had it all redone and restored. It has no computers. I can put moonshine in it, and it runs just fine, so I don't need petroleum. But we're going to have to think about this stuff. Think about what if something happened to Zoom. Think about a cyber attack on Zoom right now and how we would function. And those are the things that people aren't really, where's our homeland security and all that stuff? We're taking our damn shoes off at the airport, or, I'm going through the clear system and the eye scan won't work, my fingerprints won't work. And they said, okay, don't tell anybody, just go on in. That's happening in Atlanta this morning. And I was wearing this. Would you have let me go through this? I wouldn't have let me go through. But, you got to stay optimistic. So I'm one of those guys. I'm not the glass is half full. Did you figure that out? And I'm not half empty. I just want to know where the other half of the water went, and that's where I'll go. And I think the story is Zoomtown, secondary markets, tertiary markets, were the fundamentals of what we built after World War II, the greatest generation, and it started with education. You want to fix all this divide. make sure that every kid in America gets the same top quality education. And if that means we have bad family school systems and we have to make them charter schools, I don't care whether they're green, brown, purple, white, or whatever. If you give a kid, my parents gave, we weren't wealthy, but they gave each of us kids 12 years of private education. That was my life launch. Without that education, I couldn't have done anything. So why should I be a winner and some other kid a loser just because it was economics? So if you want to equalize all this stuff, just focus on education, get supply chain back, move it north-south, let Texas continue to frack to keep pressure on the San Andreas Fault so California just goes in the ocean and America's fixed. Any other questions? I'm game.
Can I ask one more question? People can leave. Okay, so you were with us 3 years ago, talking about Amazon HQ, right?
Yep.
This is when we were all like, oh, Wisconsin could get the headquarters, and everybody was putting in their submission, and you called it, because I think you saw it happening, where what Amazon was doing was collecting all this information about all these little places where they can do their
Yep.
sub-headquarters, and, nobody really got a headquarters. So, did everything that you had predicted come true about that? And any comments just related to that? And then you can close it up anywhere.
So you're right. What they really were doing was they said, how can we have this mass data collection on everything in America? Because it's not just about an HQ2. They were just expanding and saying, let's make sure our growth was going to Europe and the East Coast was becoming more important. So we probably needed to have disciplines and executives on the other part of the country. But it was all about this mass data intelligence gathering. So if you look at the 20 city finalists in there, and even a few that weren't, like, I'll give you a crazy one, Birmingham, Alabama. So I'm over there at the University of Alabama. They're all excited. They're putting Amazon boxes over all the office buildings and say, this is what's going to win it. Tucson, Arizona said, we're going to send them a big cactus, and that's going to win it. And, you're just shaking your head. But they appreciated that they engaged and competed. And they collected all the data. Today, Birmingham, Alabama has 3 of Amazon's biggest e-commerce fulfillment centers for the Mid-South, to such a degree that the union labor is trying to unionize Amazon through Alabama. Imagine Alabama, which I think it's like, you're the wrong SEC football team that they're going to run over if you're doing anything union. Tucson, Arizona, that sent that cactus, they have 2 of the largest. They'll be rivaling for 2 or 3 more. You look at Nashville, Tennessee, in Boston got the data IT staff, 5,000 jobs. And so what they looked at, they said Nashville, Vanderbilt, math people, good scientists close to Huntsville, they put all that stuff together. And that's what I think companies are doing today. That was the real takeaway from the HQ2 search, is how can you get the rest of the country to tell you everything you want to know and do the research while you sit back and profit from it. And when you look at where they put all of their e-commerce warehouses, it very much correlated to all of that competition. People thought I was crazy. I was the only one that had Columbus, Ohio as one of the 20 finalists. And they said, are you crazy? And I said, yeah, I am. But let me tell you why. Do you understand anything about Columbus, Ohio? Anybody from Columbus? Know Columbus? So they are logistics. All of the air cargo that used to go into New York airports, it now goes into Rickenbacker Airport. They love it so much, they were at the NCAA women's basketball final tournament in Columbus right before that decision was made. Ohio State University, tremendous on logistics. They have a thing called the NCMM, the National Center for Middle Market. It's where all the companies that have proven their concept, have over $1 million, up to $100 million in revenue, that's where they go and figure out where do we go from there. And guess who now is one of the big sponsors of that? Amazon. So these big companies learned a big lesson. They said, that's a good scheme. We could try that trick too, but Amazon did it so well. And they have so much data on us now. They now have used that data where in every city, they've identified what they call the density of zip codes. They know the 3 or 4 zip codes that have like over half the packages going to. And they're picking up those zip codes, and now they're doing what's called retail to industrial conversions. They're going in and they're buying old Kmart's and Toys R Us, and they're using those as staging centers at night to take stuff out of the big warehouse in that town, put them there to then stage half the packages going into those 3 zip codes around there. It's absolutely amazing. It's a really interesting story, but we kind of all forgot, about Amazon other than I think before it's all over, we're going to have to do an AT&T, a 1980s AT&T to Facebook, Amazon. I mean, when you think of the size of these companies and what we broke AT&T up over and where these people are, I don't do Facebook. I don't do Twitter. I won't own an Apple product. All of the data centers for these companies, they're putting them in China. All of our information, all of our intelligence, China's mandating, if you want to be with us, you got to put all your stuff here. And so what do you think happens when they want to know all that data and they have it, or they're downloaded, or they're helping them in the construction so it downloads? We don't have a clue. Our millennial generation does not value privacy and understand the cyber risks that we face today. So, and I'll tell you the last thing, if you have a kid, so this is why I got to retire within 7 to 10 years. The most important skill that an executive is going to have a decade from now is coding. We make decisions on software every day, and we don't have a clue about how that coding software works. Is it secure? Is it safe? How do I look for certain things? Within 10 years, every chief logistics officer, every chief financial officer will have to have some coding expertise, credible certifications, or they'll be out. It won't be a CFO, CLO, CEO. The CEO at Procter & Gamble that spoke this morning has 3 different super IT certifications to understand just how his supply chain works. So go get coding experience and you'll find all the Mandarin that's in the code there that's basically screwing us up, or the Russian. Oh, good question. Thank you. Now go get your warm clothing on. Thank you. Appreciate it.